Hey, it's Pam, your first CFO, coming at you again with today's financial tip. First of all, though, a reminder that I can still get free copies of the book, Your First CFO, out to as many people as possible before my hard copies come in. So, PM, leave a message, share, like, do something to tell me that you know somebody or you'd like a free copy of the book. It's all about how to set up finances in your business so that you can love them instead of dread them or hate them. And I promise it is working, and it has worked for current and previous clients. So I encourage you to grab a copy of it. It's put together so that it can be entirely implemented without needing to get outside assistance to do it or anything like that. It's very self-contained. So just wanted you to know that was available. The other piece of big news is that we are launching the Cash Flow podcast on September 12th. And I really look forward to getting on the air on a regular basis every week with new episodes. We're going to start with 4 episodes on September 12th. Currently building up my launch team for that and would love to have you join. So if you're interested, again, reach out to me via Facebook, PM, share, hit a message on my page, or just comment on this post, and we'll make sure we get you involved in the launch process. So I wanted to get that stuff out of the way first, but then launch into the topic that I seem to be on right now, which is instead of thinking of the year in quarters and waiting till October 1st to say, hey, we're in the last quarter, let's do all of these things, I'm thinking of the year in thirds. And as a result, when I stop and do that, I've got 4 months left to do some things that can really help me out when it comes to that dreaded T word. Should be a 4-letter word, but it's not. It's a 3-letter word, 5-letter word if you make it plural, and that's taxes. So I am going to talk about that again today, but I promise not like a tax accountant, really like a CFO. And if you had a CFO in your business, or if you had a CFO by your side, if as a 1099 employee or contractor, what that CFO would be saying is what I'm going to say to you today. So let's just pretend that if you don't have a CFO, if you do, I'm sure you've already got this covered. But if you don't, let's pretend I'm your CFO today, and I'm looking right at you in the eyeball and saying, step 1 to making finances fun is to make them less painful. One of the biggest pain points for everybody with finances, and it's everybody, all of us have been here at one point or another, unless you're just a first-time non-employee wage earner. We've all been in a position where taxes have jumped up and slapped us in the face, and it's never fun. And there's so many lessons learned that we just can't, I don't think, as entrepreneurs, go on without sharing with the next generation of entrepreneurs the ways that you can avoid those nasty surprises that some of us have managed to walk into. So even as an accounting geek, I've had my share of trouble with this, and I've learned from it very early on in my career. And I want to make sure you learn from it without the pain point. So you've got a third of the year left. That's a big chunk of time. And the good news is that this particular tip applies if you're profitable. And I want to go a little deeper on this. I've talked about it for the last couple of days in general, but I just want to dive in a little bit deeper for you to tell you in what I call entrepreneur's English what you can do about taxes. Some of the things you can do to take the sting out of what I call the April surprise. And if you start now, if you start with 4 months left in the year, it gets a lot easier than if you wake up on October 1st and say, hey, we're in the last quarter. Because there's so much chaos that comes with the last quarter of the year, right? You've got one more quarter to achieve all those business objectives. You've got that quarter to start planning for next year. All sorts of things start to happen as a business owner in that last quarter. So I kind of raise my hand here in the beginning of September and say, hey, we got 4 months left, not just 3. So let's deal with this big bad dinosaur that's going to pop out of the woodwork next April. A lot of people have said to me, hey, what's the Trump impact going to be on taxes? And the real answer to that is we don't know. So you will get political opinions about that. But any tax accountant worth their salt right now, any CFO worth their salt right now who is just giving you an objective opinion will be able to say to you with 100% certainty they have no idea what the impact on our taxes next year is going to be as a result of the Trump presidency. So let's just tuck that aside for a minute. Because truth be told, usually from year to year to year, when there's not a political change, we have a reasonable estimate of what's going to happen or not happen with the tax code. Right now, people are like, well, we have no idea what's going to happen. And what I'd say to you is operate under that assumption then. Since you have no idea what's going to happen, let's revert to the next best thing. And the next best thing with taxes, if you don't know what's going to happen, is to just assume you want to pay as little tax as possible this year. Let's just assume that. Now, I want to put huge cautions on this because there are two things, and this is really important for every business owner, including 1099 employees. A lot of advisors will tell you, or you'll hear half of the story, and they'll say, oh, if you're going to have a profit, say you're going to have a profit of $10,000 at the end of the year, they'll say, quick, go spend $10,000. And I just want to step back from that a little bit because although the advice is not necessarily wrong, there are a couple of things you want to make sure are absolutely certain before you do that. And this is to save you from running into trouble that, again, I've seen plenty of people run into. You want to make sure, number one, that if you're going to spend money just to minimize your tax burden for the year, one, make absolutely sure that you have the cash to do it, or that you can utilize your credit in a way that doesn't hurt you. Don't just willy-nilly go out and say, I can't believe I just said willy-nilly, but I did. Don't just go out there and say, hey, I'm going to have $10,000 in profit, so here's my credit card, put $10,000 of expenses on it. Make sure you've got the cash to cover this. If you don't, it's not good to proceed down the path that I'm going to talk about here. So, number one, make sure you have cash available. Number two, if you're going to spend money to reduce your tax burden, make sure you're spending it on stuff that really does help your business, that you really would have bought anyway later on. So the two things we want to make sure of before you just spend money to reduce that tax bill is I've got the cash and I need what I'm buying. A lot of times people will just go out and say, oh, I don't want to pay my tax bill, which is going to cost me, let's just say in this example, $3,000. So I'm going to go spend $10,000 and buy stuff. And if A, you don't have the cash to do that, or B, you don't need the stuff, you've really just wasted $7,000. And that's the reality I kind of want to drive home. So although some accountants will say, let's spend, look at that cautiously. It can be good advice if you're in a good situation where you have some free cash flow and you know you're going to have money in the bank, and you need whatever it is you're going to buy. Like you need it and you would have bought it anyway, just a little bit later. You had it in your plans for next year. So that's kind of thing number one. So if you can do that and you meet all of those restrictions and it makes sense for you to buy stuff, absolutely go ahead and do it. But if it doesn't, if you don't happen to be sitting around with $10,000 of cash to spend, and if there's really not anything you were going to buy early next year to accelerate your business growth, then it comes down to the fact that, okay, I'm going to have to pay these taxes. So if that's the case, and say your tax bill on this $10,000 was going to be $3,000, you've got 6 months, 7 months, 8 months to save it. And that's what I want to mention. So say you know now on September 1st, you're going to make profit of $10,000 in your business, and you're going to get taxed about $3,000. You have the months of September, October, November, December, January, February, March, and half of April. So 7.5 months. Yes, I do still count on my fingers. You've got 7.5 months to save that money up. So you can get away with putting aside $400 a month, $500 a month for the next 7 months, instead of getting to April 15th and somebody coming up to you and saying, hey, I need a check for $3,000 to file your taxes. So I just wanted to get that out there because I think people don't realize that if you start looking at this in September, you don't just have 4 months to save money. You've got 8 months to save money. That's 2/3 of a year to save up the money you need to pay your taxes. So if you haven't been taking money aside, if you haven't been making estimated tax payments, which is the next level of performance that we'll talk about soon, but say you're not doing any of that, at the very least, start tucking money away because you've got 8 months to do it. So I just wanted to throw that out there for you to think about. Don't get hit with the April surprise. You don't have to. And you don't even have to think about trying to cover your tax bill in 2 or 3 months by the end of the year. You got 8 months to do it. So take your time, plan, and definitely take advantage of the fact that you've got more than a quarter left in 2017. It's Pam, your first CFO, and I will be back with more later. Take care.